This is a chart of pound against the dollar on a daily chart. Each one of these candles represents a day. Now, pound against the dollar, does anybody know the nickname for pound against the dollar? Anyone?
Sorry, what?
Don't you?
Can you repeat the question?
Does anyone know the nickname for pound against the dollar?
Cable.
Cable. Do you know why?
No.
No? Do you want to take a guess? Okay, I'll leave them. So, way back when, and before TV and all that kind of stuff, the quotes used to come overnight. You used to have the overnight quote from the London to the New York Stock Exchange, which give you the exchange rate of pound against the dollar. Somebody had the idea to run a cable along the seafloor, right? And so you would have, when you went to exchange money or to trade or anything like that, you'd have the overnight quotes and you have the quote on the cable. Obviously everybody's going to go for the quote on the cable. It's more accurate, it's quicker, it's faster. So that market kind of faded away, the overnight quotes, and people traded the cable. So in Britain, anybody who calls pound against the dollar, anybody who calls cable pound against the dollar, you kind of give them an odd look. They've not been in the industry too long. So let's talk about some technical analysis. Everybody kind of with me so far on the whole candlestick charts and all that. If you're not, it's not crucial, don't worry. One of the first things I'll do is apply support and resistance levels on my chart. What is a support and resistance level? It's simply a level in the market, price level that the market is respected, right? And that's at 1.4 there on that chart. If you can't see why that level's drawn in there, hopefully those arrows help you out a little bit, right? So the market has found resistance on this level from the underside, 1, 2, 3, 4 times. And when it's broken, it's found support on the upside, right, when it's come back down into it. For those of you who aren't familiar with technical analysis, you're probably wondering why that works. If that works, why does it work? Well, you can't be blamed. It sounds a bit random, but there's a multitude of factors. It can simply be broken down into human psychology, though, right? Humans, what do humans do? They react to things in a relatively consistent manner, right? I'm sure you can think of a number of examples: road rage, people who cry at movies, all that kind of stuff. Everybody's got that like aunt or something like that. It's super predictable. Chuck something on TV, she's going to be crying by the end of it, right? So people react to things in a consistent manner, and humans repeat their actions as well, right? People just think about gambling and these types of things. This is how trading can become for some people, but they just can't stop. No matter how many times they get burned, they just keep on going back. Just keep on going back. What this boils down to is that humans are predictable, right? I'm sure some of you can see where I'm going with this. If the market is driven by market participants, which are people, for the most part, you have HFTs, algos and all that kind of stuff, but for the most part it's people. If we understand how people act and react to certain market patterns and ratios and all that kind of stuff, we can gain a pretty good idea of how the market might react, considering it's driven by its participants. In other words, technical analysis is self-fulfilling. Now some of you are probably looking at me thinking, yeah, sure it is. So let's look. What do we think is going to happen here? Hands up for bounce. Is it going to bounce? Is it going to go to the upside? Everyone, let's get some input. Is it going to break? See, not everybody's putting their hands up, but okay. Well, those of you who said bounce, you're probably feeling pretty betrayed right now, right? You're probably thinking, but you just told me that things happen in a consistent manner and all that. You're right. 9 times out of 10, you think, yeah, this is absolutely going to work. If you feel a little bit kind of betrayed, you feel a bit confused, that's what your first year trading, you're going to feel a lot of that, right? You'll see this happen and you'll think, yup, this is going to bounce, and you'll buy, and then that'll happen. And then the next time you see that happen, you're going to go, well, last time it went through, so I'm going to sell. And then you'll sell, and then it'll bounce. And you're just going to keep on chopping back and forth. It's going to happen a lot in your first year trading. So, whilst technical analysis should work out, and we have probabilities and all that kind of stuff, it's not guaranteed. Nothing is guaranteed. And this is where we have to we have to come up with a way of analysing the markets that's going to give us a very probabilistic outcome. And this is where we layer up technical analysis, right? So not only am I going to put a support and resistance level on, but I'm also going to put a Fibonacci retracement tool on, right? Some of you are probably like, right, but I'll explain. So you take that from the high of the move to the low of the move like this, and what I'm expecting to happen is all this is doing is it's giving me percentage ratios of the move. So this is 0% here, this is 100%, and as the market trades up, it's trading up towards 100%. So it's just giving me ratios. It's just a simple graphic that's applied to the screen that's giving me ratios of how far the market is pulled back. So what I'm expecting to happen is we've had a down move, I'm expecting a pullback before a further down move. And so I think, well, last time the market came into that 1.4 level here, it just absolutely collapsed straight through it. So when it trades back up into it from the underside, I don't have the confidence to say, is it going to bounce, is it going to break? So that's why I layer up confluence, right? I layer up these sort of tools to give me further evidence to suggest one thing is more likely to happen than the other. If you're confused, think about what I said about it being self-fulfilling. Loads of people use this tool, loads of people look at support and resistance. So as the market trades back up into that level at 1.4, which is in there, they're going to see that there's a 50% Fibonacci retracement level there. They're going to see that there's a level there. And what are they going to do? They're going to try and step in and sell it, expecting the market to bounce. And so I'm thinking straight away, well, I want to try and be a seller here. Had a big down move, see a little retracement to that level where I know people are going to be stepping in. Remember that self-fulfilling nature of technical analysis. Where am I going to target though? Where am I going to say, enough's enough, I've sold, the market's went in my favour, where am I going to get out? You'll notice there's a fib level that I've not spoken about, and that's the minus 27. Again, these Fibonacci retracement numbers are based on the Fibonacci number sequence, the relationship between these numbers. And you know, the Fibonacci ratio can be found in nature, you find it in the human body, you know, 2 arms, 5 fingers, all that kind of stuff. Now, I'm looking to target that negative 27. Why? Because I've tested this over and over again, and I know it works. All this is it's a 27% extension past the zero. So I want to sell there, I want to buy back there, I want to exit the trade there. And like clockwork, it works out, right? Now, notice what happens when the price hits the negative 27. It bounces. Why? Okay. So if people sold at the 50, what do they have to do to get out of their position? They have to buy back. So if people are looking at these Fibonacci tools and all this kind of stuff, when price hits that negative 27, they're going to be closing their position. If they sold 10 contracts here, they're going to buy 10 contracts here to close their position. So what happens is people sell in the market here, causes weakness. As the market trades down and it hits that negative 27, they buy back their 10 contracts. All it takes is a flurry of people to do that. You now have buyers present in the market will bounce.